All right, everybody, we should be starting here in a couple minutes. So just sit here and I guess look at my face. And we'll come back in a minute or two. While we're waiting, if you guys are new, if this is the first Q&A that you've been on, if you have questions, you should see the questions box or the chat box. And so put your questions in there if you have questions during these slides, and we will make sure to answer them. If it's something that we can't answer on the call, we'll just reach out after the Q&A session and go from there. But please do ask any questions that you may have during the event, and we will try to address them as soon as possible.
You should do a separate webcast explaining all that memorabilia you have on your bookshelf.
Yeah, you'd have to be a Seahawks fan to like it, though. My Russell Wilson ball went down a little lower, so you can't see it, since he's playing for the Broncos.
Yeah, it's going to be weird to see that.
It is. I can't wait for week one, especially if we come out on the winning end of that. So.
Is that who they play?
Yeah, week one I think is Denver.
Wow.
So it'll be
it's funny how it always works out like that.
Yeah. Well, especially after we won against Denver in the Super Bowl, I think we played them week one after we beat them in the Super Bowl, if I remember correctly, too. The following year. So. Well, more people trickle in since it is 12:01. Let's get started. So today's event is, again, just for educational purposes. Jeff, our guest today, is going to talk about the differences between mutual funds and ETFs and kind of the pros and cons about both, and how the ETF structures kind of changed over the years, and why it may make more sense now than it did in the past. So, Jeff, thanks for joining us. If you don't mind by starting off and giving us a little bit of background about you, and then getting into the meat of the Q&A.
Yeah, happy to, and thanks for having me on. So I work at Avantis Investors. We are an asset management firm that has both ETFs and mutual funds. I joined in 2019. Before that, I worked at Dimensional Fund Advisors, going all the way back to 2002. So I was there quite a while, and while I was there, our main investment strategy was in a mutual fund format. So my first exposure to really learning about the intricacies of ETFs and how they, how they are similar and different from mutual funds came from joining Avantis. So it was kind of, for me personally, a really deep crash course in ETFs. And so, that's a little bit about my experience. Having said that, since our current organization has both mutual funds and ETFs, and they're actually provided to the marketplace with the same design and the same cost, it's fair to say I'm in a very objective position to talk about the two different strategies, which isn't always the case in the industry, because you have some firms that only have ETFs, some that only have mutual funds. We have both, and the ones where we have both, same design, the same cost. So there's no kind of incentive to really push one way or the other. apart from like true, benefits of the different structures. So that's just a little bit of background there.
And while you were talking, there was a question that came in that was asking if we're going to be covering the tax impact differences of the ETF, and we will cover that towards the end of the presentation. So stay tuned.
Yes, that's a big part of the presentation. Okay, so let's get into this. What's the goal? Well, hopefully to not put you to sleep. Like, this is, I recognize, a fairly dry subject, but the fact that you're here shows that you have an interest in the subject, which is great. So I trust that you probably won't fall asleep. But yeah, the goal is really to understand a bit more about how a mutual fund works and how an ETF works, and what the potential benefits and also maybe limitations of the way they work has an impact on you as an investor. Okay, so before we kind of start to talk about the differences, let's talk about the similarities. Both mutual funds and ETFs, and by the way, ETF stands for Exchange Traded Fund. So you have the word fund there. They're both vehicles to get exposure to pooled investments. So they both give you the opportunity to participate in a diversified strategy. And it wasn't until the last few years where you could have an ETF that deviated from an index. So it used to be the case that an ETF was synonymous with an index fund. It had to track an index. Now that's changed, so you can have ETFs that apply academic research and target a certain part of the market, and they can have weights. The weight of each security in the portfolio can deviate from a market cap weight, and an ETF can be managed on a daily basis, just like a mutual fund. So, Aaron kind of alluded to some things that have changed with respect to ETFs. That's one of the biggest changes, is that you can now, have a lot of flexibility in terms of the stocks or bonds that you want to hold in an ETF and what the weights are, and you can manage that on a daily basis, just like you could a mutual fund. So those are some similarities. I also will mention, just from a regulatory standpoint, both mutual funds and the vast majority of ETFs are regulated under the same regulation, which is the Investment Company Act of 1940. So all new investments have to be registered with the SEC. They face the same kind of disclosure requirements. So there's, from a regulatory standpoint, there's really no difference. So bottom line is, they both give you the ability to get diversified exposure. They both can be daily managed, and they're regulated the same way.
Yeah, and one of the ways I always like to, because it's super simplistic and I can visualize it, I'm kind of a visual person, with the difference between a mutual fund and an ETF, is think of those as like a wrapper. And I always make the comparison of think about going to Home Depot or Lowe's. You buy one of those orange or blue buckets, and they shove a bunch of different stocks into those buckets. The bucket is the mutual fund or the ETF.
It's a great description. Yeah.
You can see I spend way too much time at Home Depot or Lowe's. So.
Well, at least you own a home. I still rent. So yeah. Hopefully one day I'll be spending time at Home Depot.
Yes.
I wanted to give you some facts on just kind of the size of the market for mutual funds and ETFs too. So looking at data, and this is from the Investment Company Institute, which every year publishes really good data on the whole investment landscape. So as of the end of 2021, in the US, there were over 8,000 mutual funds with 27 trillion in assets. At the end of 2021, for ETFs, there's about 2,600 ETFs with assets of about 7 trillion. So ETFs represent a smaller share of the marketplace, but what we're seeing is the growth of the ETF market in just about every metric. So the number of ETFs year over year is growing. The cash flows going into ETFs is growing, and in much more than what we see in mutual funds. So for example, last year, with respect to domestic stocks, so domestic equity, ETFs had net inflows of 520 billion, and domestic equity mutual funds actually had net outflows of 419 billion. So we are seeing kind of a shift toward ETFs happening across the industry. In my experience working with financial advisors, there is definitely an increased usage of ETFs. So it is an important topic. It is definitely worth kind of understanding the difference between the two and why perhaps there is this growth in ETFs. All right. Any other questions at this point?
Not so far.
Okay. All right. So we talked about the similarities. Now we're going to get into the differences, and really to understand the differences, we have to get into the weeds a little bit. So hopefully you can bear with me, and if there's any questions or any jargon that's not clear, please feel free to ask about it. And so what we're going to do is we're going to first kind of walk through how a mutual fund, how an investor interacts with a mutual fund, and then what the implications of that interaction, what the implications are of that interaction. Okay, so with a mutual fund, we have our investor over here that's thinking about money, and they want to buy a mutual fund. So they are going to actually interact directly with the mutual fund company via their brokerage account. So, you know, it sounds like your brokerage account, Aaron, right, is Pershing.
Yep.
So your trades are placed through Pershing's platform. Those eventually get to the mutual fund manager. The price that you pay is going to be what's called the NAV of the mutual fund. That stands for net asset value, and it's calculated at the end of the day after the markets close, and it's a process of basically adding up the value of all the holdings, whether it be stocks or bonds, inside the fund, and then subtracting out all the costs associated with managing that fund. And so at the end of the day, you get a price. And as an investor, if you're buying the fund, you know that you're going to get that price at the end of the day, and it's going to be, you know, at that point in time, the fair reflection of the value of all the securities minus all the costs. Now, mechanically, the way this gets to the portfolio manager of the mutual fund, every one of these brokerage firms, Pershing, Schwab, Fidelity, they basically every day are adding up all the transactions that are buying the mutual fund, all the transactions that are selling the mutual fund, and they're netting those out so that there's essentially one transaction coming from Pershing, one from Schwab, one from Fidelity, and so on and so forth, that represents either a net buy or a net sell. And then those get to the portfolio manager of the mutual fund later in the evening, sometimes very late, like midnight. In some occasions, they come in the morning. And so the portfolio manager, typically will come into work in the morning. They see these numbers and they know they either need to go into the market and buy stocks or sell stocks the next day. And so now they're gonna do their portfolio management activities. All of that activity then ends up in the net asset value at the end of that day. And so if there's buying and selling of securities, it's going to obviously involve the commissions that are paid for the trades. They're going to have some costs related to the spread of all the securities they're buying or selling. And then there's other kind of specific costs like exchange fees. Some international markets have stamp duties. If the manager is, needs to trade quickly, there could be market impact. So these are kind of all the direct and indirect costs that happen when a portfolio manager of a mutual fund is trading in the marketplace. All that activity ends up in the net asset value at the end of the day. The reason I bring that up is because one of the key kind of things to be aware of is that when you're in a mutual fund, you share in the costs associated with the management of that fund. So they're incremental costs, but ultimately, if we're all in the mutual fund, we're all sharing in the activity of other investors that are buying and selling that mutual fund.
And so what that means, Jeff, and correct me if I'm wrong, is let's just assume that investor A didn't make any changes, but investor B did. Investor A, even though they didn't make any changes, would still be more or less having some of the costs associated with what investor B did.
That's right. Yeah. And
all this stuff, obviously, for the audience, happens behind the scenes. So you don't see this stuff happening, right? This is all behind the scenes. All you see is, hey, I bought this and sold that, and all the rest of the stuff that Jeff is talking about is kind of more behind the scenes, behind the curtain type look.
Yeah, we're getting into the weeds, but it's gonna kind of be more impactful once we kind of contrast this with what happens in an ETF. But yeah, the punchline is you're in a mutual fund, you're going to be in there with other investors, and you want everybody to behave like long-term investors, let's put it that way. So if you're in a mutual fund that's exposed to a lot of retail investors that maybe are more prone to panicking if the market's really volatile and they're blowing out of the fund, Well, all the costs of having to sell those securities or have a bigger cash buffer inside the mutual fund, those are borne by everybody else in the strategy. So yeah, if you did nothing and you're sitting there, but everybody else was selling, you're going to be stuck with your proportionate share of those costs. And so it's important, to know that you're in a mutual fund where the vast majority of the other shareholders are long-term, sticking with the strategy, and there's not a lot of hot money moving in and out. Questions about that?
No, the only thing I would add too is also the style of mutual funds. So, some of you guys have heard us talk about active and passive mutual funds. And so the more active the mutual fund is, right now we've just been talking about the investors, but the more active the mutual fund is, where they're buying and trading, shares and trying to guess what the next best thing is or what's going to happen the next day or whatever, obviously brings more cost too. So one of the ways to help mitigate some of that, like Jeff said, was if you're going to be in a mutual fund, be in a mutual fund that historically has those longer term investors in it. And
yeah, I mean,
one question came, and so does the trading affect the taxation of the non-trading client?
Yeah,
I think we're going to talk about this a little bit later, but do you want to give a little teaser on that at all, Jeff?
Yeah, so at this point we've kind of talked about the mechanics, but of course a really important thing to know is that mutual funds are, when they're buying and selling securities, they're cash-based transactions. So they're spending cash to buy securities, or they're raising cash when they sell securities. And because of that, all those transactions are taxable events. So if they're selling securities and there's a gain, that's going to be a capital gain. If they're selling securities and there's a loss, that's a capital loss. They can use losses to offset gains. And then they also keep track of the lots of securities, which means the cost that the price they paid when they purchased the security. And so they will tend to, and we'll get into this more in a second, they'll prioritize the lots with the highest cost basis to try and minimize the capital gains distributions. But the answer to the question is yes, the activity of others could generate taxes for those who didn't sell, and that's one of the potential frustrations that we hear a lot about, especially obviously if you're in a taxable account and you have mutual funds.
Yeah, and just so everyone understands, cost basis too is the amount that one would pay for the share, or the amount that somebody paid for the share. So like if you had a mutual fund and when you bought it, it was worth $10 and you own one share, the cost basis of that would be $10. So if you sell it and it's worth $12, the gain would be $2.
Yeah. Okay. So now let's talk about, we're going to basically walk through how this works in an ETF, and then it will kind of, all hopefully come together. Okay, so an ETF stands for exchange traded fund. So you can think of it as like a mutual fund that trades in the exchange. So it trades in the market like a stock. The difference is that stocks have a limited quantity, ETFs have an unlimited quantity, and you have financial institutions called authorized participants and that's what you see in the middle. And they have legal contracts with the providers of the ETFs so that they can create and redeem shares of the ETF. So they can actually go to the ETF manager and create more shares. So if there's a lot of demand to buy a particular ETF, in all likelihood, they'll go and create more shares to satisfy that demand on the exchange. So with an ETF, we have our buyer over here. If this investor wants to buy an ETF, they are going to interact in the live market. They're not interacting with a mutual fund. We purchased and sold our shares directly to the fund company through our brokerage account. Now what we're going to do is we're going to buy and sell our shares in the market through our brokerage account. So we're not actually interacting with the ETF manager. So we talked about.
With that being said, Jeff, does that then, since you're not interacting with the mutual fund company and there's kind of an in-between person, does that bring additional costs to the ETF or take away cost, or is it like cost neutral?
Yeah. So, okay. So, and this is kind of the beauty of the structure. When investors buy and sell their ETF shares, they're doing it in what's called the secondary market. So you're trading with other market participants. Some of those are market makers, some are other investors. And all of that activity actually does not result in any trading in the actual securities held by the ETF. So remember how we were talking about you're buying or selling the mutual fund, and then eventually the number, the net purchase or net sale number gets to the portfolio manager, and say they have, say it's 20 million that they need to buy worth of stocks. So then they have to go into the market and they have to go and spend 20 million buying a bunch of different stocks that they want to hold in the portfolio, and they're subject to the spread on the stocks. They're subject to commissions, exchange fees, all those fees. In an ETF, that doesn't happen. So you're basically trading your shares with other investors in the secondary market. And if there's a need to get more shares, this authorized participant comes to the ETF manager and they do what's called a creation unit. And so, that'll be a huge block of ETF shares, like 50,000 shares. And so in order to get those shares, they go out and scoop up a bunch of stocks that we want to hold in the ETF, and they give those to us, and we give them the shares. This is what's called an in-kind transaction. There was no purchasing of securities for cash. There's a trade that takes place of ETF shares for individual stock shares of an equal amount happening at the end of the day. So everything's at, similar to a mutual fund where you have the markets have closed and you have the net asset value created. Similarly, you get the net asset value for the ETFs and you have the closing price of all the individual stocks, and those equal amounts are traded. Because it was in kind, it's not a taxable event. It also didn't result in any trading. So there's no costs associated with the trading. So this is why the ETF structure is a very efficient way to run a diversified strategy. It really minimizes a lot of the costs and mitigates a lot of the tax impact.
And was that one of those changes that happened, if my memory is correct, in 2019 that made ETFs a little bit more attractive than they were in the past? Is that one of them, or has that kind of always been that way?
This process has always been this way. The change in 2019 relates to what's called the basket. The basket is basically the portfolio of stocks that the ETF holds or wants to hold.
Okay.
And so in the past, this in-kind transaction would represent a proportionate slice of what's in the portfolio. So all the, say there's 600 stocks, the basket would reflect all those 600 stocks in the proportion, of the weights in the portfolio, and you would trade that. What changed in 2019 is that you don't have to do a proportionate basket. You can negotiate a basket that represents a subset of stocks. And so that basically allows an ETF manager to do even more precise rebalancing of their portfolio and it makes it even more it was already very tax efficient because you're doing an in-kind trade, and you're going to tend to send the stocks that you pick to send out are going to be the ones with the lowest basis. Now you can use that custom basket process to get even more specific around the basis, around the stocks you want to send out, because maybe the expected return profile's changed. So yeah, it gives you even more flexibility.
Okay. And then there was a question that came in too. If there are no trading costs, how are the parties compensated? And one of the items I want to kind of clarify is at the custodian level with, like, our clients, the Pershings, the Schwabs, there is still a trade cost there to execute the trade. But as far as the trade from the primary and secondary market, can you kind of discuss that, Jeff? How in a mutual fund there are costs, but in the ETF there isn't.
Yeah. So what's basically happening is the costs that we talked about in the mutual fund of going out and buying and selling securities, that is now being transferred into not perfect one-to-one transfer, but it's basically ending up in the spread that you face when you buy an ETF. And so we haven't really talked about the spread yet, but just like you have, if you're going to buy an individual stock, you face a bid-ask spread that's, let's say the true value of a stock is $10, but if you want to go buy that in the market, you face the spread. So if you want to buy it, it may be $10.05. If you were going to sell it in the market, it may be $9.95. So there's a spread around the true value, and that spread is there to compensate market makers, and also it's there for them because they have some risks because they have an inventory of ETFs and individual stocks. So part of the spread is also a hedge for them to manage some of the risks that they face. Now, what's nice about that is that if you own the ETF, you're shielded from the activity of other investors that own the ETF, because all their activity is happening on the secondary market. You pay your way into the ETF, so you pay part of the spread to get into the ETF. If you want to get out of the ETF, you pay the cost to get out, but you don't impose that cost on other shareholders in the ETF. So if there's all of a sudden a bunch of people selling their ETFs, that is not causing a portfolio manager to go into the market and sell individual stocks in the market and face the spread and pay the commissions. Instead, you're selling your ETF shares, someone's buying them, you pay the spread because you want to get out, so you paid your own costs to get out. Now let's say the market maker, the authorized participant, has more ETF shares than they want to hold. What do? They come to us, the ETF manager, and they trade those ETF shares for individual stocks. So now it's the reverse of what we talked about before. We take in ETF shares, we take a chunk of our portfolio of individual stocks, and we give those to the authorized participant. So there was no actual trading that took place.
And there was a follow-up question to that, and I think I understand what's being asked. But so the question was, but that change in value does affect me, right? And I think what they're saying is, you know, if there were net redemptions of the ETF, does that then affect this? Which I don't think it. Again, it does it? Because it's the underlying value of the individual holdings.
You cut out a little bit in the beginning. I think the question was if there's a lot of redemption in an ETF, does that affect?
Yeah, the value of the ETF. Let me see. So referring to the underlying holdings, it says.
Yeah, well, you're gonna be shielded from any of the potential costs associated with a redemption like you would have in a mutual fund, where the portfolio manager, so think about it this way: if a mutual fund has persistent redemptions, typically they're going to have more cash inside the portfolio to help meet those redemptions. Like they have a cash balance. So there's a drag on the expected return because you don't earn anything from cash. So you have the cash balance. You also will have a credit line. So if you don't have enough cash to meet a redemption, you have to tap into the credit line. And then what's going to happen is you go and you sell stocks to replenish the cash balance and pay off the loan. So that activity is not happening at all in an ETF. You have very little cash, you don't need a credit line, and you're not selling stocks to meet a redemption. All the redemption activity is happening on the secondary market.
Okay.
Now, the price is going to be a function of the holdings inside the ETF. So if the price of the stocks in the ETF is going down, then the price of the ETF is going to go down. If the price of the stocks is going up, the price of the ETF is going to go up.
Okay.
I don't know if I answered that, but
yeah, I think you did. If not, I'm sure they'll ask a clarifying question. For some reason, we did.
The key takeaway, apart from all the technical stuff, is that with an ETF structure, you're protected from the activity of other shareholders. With a mutual fund structure, you share in the activity of other shareholders.
Yeah. And it's kind of more a stated, I mean, in the ETF structure, theoretically, you would know your cost, where who knows in a mutual fund what's going to happen with other investors, right? And so it's kind of an unknown cost, but with an ETF structure,
it's kind of hidden, it's embedded in the net asset value. You know, if what the hope is that you're in a mutual fund that doesn't have, you know, significant persistent redemptions, because, you know, that's more costly.
Yeah.
And so, you know, I think that's kind of the key. If you're in mutual funds that are, you know, really big and diversified, and they tend to have net inflows most of the time, then the costs will be less impactful.
Okay.
The other thing to note about an ETF, I mean, we mentioned this, you're trading in a live market. There is a bid-ask spread, and it does introduce a little bit of complexity, because you do need to have an understanding of kind of best practices around trading and different types of orders. And that's why, you know, financial advisors, you know, that understand these kind of things is pretty important.
Yeah. And that's one of the things we do for our clients too, behind the scenes, so that you guys don't have to worry about it. You want to go on to the fun part of the tax treatment?
Yeah. So let's talk about the tax implications of the two structures. First, with respect to dividends, there's really no difference here. Both mutual funds and ETFs have dividend income from the securities they hold. That income is distributed to investors. Both mutual funds and ETFs will consider, so there's different types of dividend income, qualified and non-qualified. I'm not going to get into the details of that, but both structures will try to maximize the qualified dividend income, which gets the better tax rate. But neither structure has an advantage or disadvantage with respect to dividend income being qualified or non-qualified. So really where the you know, key tax impact is with respect to capital gains. Both mutual funds and ETFs realize capital gains when selling appreciated securities, and both are required to distribute at the end of the year, so this happens in December, any net capital gains realized inside the fund. Those are distributed out. With respect to a mutual fund, because the transactions are cash-based, you know, if there's a lot of selling that happens and there's realization of capital gains, you're going to see capital gains distributions at the end of the year. How do you mitigate that? Well, like Aaron said, if you have a strategy that's generally speaking not doing a lot of excessive trading, so they have lower turnover, that helps. Of course, you can offset gains with losses. So if there are embedded losses, that's going to help reduce capital gains distributions. And then we talked about before, typically if a mutual fund has to distribute capital gains, they're going to distribute the gains with the highest cost basis. So that minimizes the capital gain distribution. But the unfortunate externality of that is that they basically leave the securities with the biggest unrealized gains inside the strategy. And so that can be a potential tax liability in the future. That, you know, for example, if you're buying into a fund and it's got 40% unrealized gains inside the fund, then you're basically buying a fund where you didn't earn that unrealized gain, but you may face a distribution in the future from those gains sitting inside the strategy.
And just to clarify too, when we go through these tax treatment slides too, these you will get dividends and capital gains and all that stuff in IRAs as well. But remember, in an IRA account, the only time you get that taxation is when you take the money out, and in an IRA account, obviously, it's taxed. Whatever amount you take out is taxed because you've never paid taxes on it before. So when we talk about this tax stuff, it's more on what we call taxable accounts or brokerage accounts.
Yes, exactly. So of course, if you're in a tax shielded account, you don't have to worry about this. It's really in a taxable account where you face paying taxes on gains. So with respect to an ETF, now you understand an ETF is primarily, and I should be clear here, it may not be 100% of the transactions are in kind, but it's the vast majority of the transactions are in kind, trading shares for stocks and vice versa. The ETF manager does very little traditional trading for cash, and if they do, it's usually lock in some losses in case there are situations where you have you're not allowed to do an in-kind transaction, for example, like some countries don't allow it, and so you do have to trade. And so then you want to lock in some losses so that you can offset those potential gains that you have less control over. But by and large, ETFs are doing the vast majority of their trading in kind and sending out securities that that have the lowest basis. And so it's the opposite of a mutual fund. If a mutual fund has to sell, they want to sell securities with the highest cost basis that minimizes their potential capital gain distribution. With an ETF, they're in-kinding out the securities with the lowest basis, and so they tend to eliminate capital gains distributions, and they don't have the buildup of unrealized gains like you do in a mutual fund. And so from the standpoint of if you have a choice of vehicle and you're talking about an account where you face taxation, the ETF has a significant advantage from a tax efficiency standpoint. And we can quantify that, which I'll get into in a second. Just to kind of summarize here, if you have a chance to defer tax, that's a good thing, because like in the case of an ETF, if you have no capital gains distributions, then that money is staying invested in the strategy and compounding over time, which can result in a bigger amount of money when you have to sell your shares. And if you never sell your shares, if you're going to pass them on to your heirs, then you certainly don't want to be paying those capital gain distributions along the way. What helps mitigate capital gains? Certainly low turnover, and all else equal, as we said, ETFs are going to be more tax efficient than mutual funds due to this in-kind transaction process. And it's a spectrum. If you have an investment strategy that has high expected capital gains, such as small value stocks. Let's think about a small value stock. It's a small company, so it has a lower price, and it's a value company, so it has an even lower price. So usually you want, if you're buying small value stocks, it's to increase your expected return because you expect those low price securities to appreciate in value, and the portfolio manager in a mutual fund would be selling those securities when they grow out of the asset class to reinvest in other small value securities. So it tends to be a capital gains machine. Now, if you're able to, instead of selling those securities, in-kind them out, you mitigate the capital gains impact, and it can be quite significant in an asset class like that.
Even though on the IRA accounts, you don't obviously, you don't have it, the taxation benefit that you would on a brokerage account. Do the ETFs still have significant advantages in an IRA account as well? And I would assume the answer would yes, because the costs theoretically are still down, right?
Yeah, so it comes down to the costs inside the strategy, like we were talking about. So, you know, you don't face the same magnitude of costs because you're not doing hardly any traditional trading. So that's the biggest difference. You know, if there's cost savings in terms of what you pay to purchase each strategy, you know, that can be a difference. You know, but those are a bit smaller than the benefit coming from the tax savings.
Yeah, so to me, just to summarize that, it sounds like maybe it would be, you know, is there an ETF that I feel comfortable with that represents whatever segment of the market that I'm trying to, or do I need to find that in a mutual fund, kind of?
That's a good way to think about it. I said we can model this out, and so we've looked at that, and basically the exercise is, imagine you had a portfolio of mutual funds, you know, trading in a traditional way based on the flows coming in and out and the rebalancing of the strategies. And then imagine you had the same investment strategy, but in an ETF structure where you have the benefit of this in-kind transaction process. So really the difference between the two is you can eliminate capital gains distributions in this ETF portfolio, whereas you're going to face the capital gains distributions based on the natural turnover of the strategies in your portfolio. So that's what we did using data from Morningstar, looking at the typical distributions from the strategies in this imaginary portfolio. And then we used, you know, the standard tax rates. We're not taking into account any state tax. We're just looking at federal, and we're starting with $1 million. And then we're going to look at how that value grows over time. And this is a line graph of the value, and there's 4 lines on here. So we're looking at the mutual fund portfolio before you sell anything. We're looking at the mutual fund portfolio after you sell your shares. So that's the light brown. The dark brown is before you sell your shares. And then we're looking at that ETF portfolio with the same expected returns, the same return assumptions as the mutual fund. The only difference is there's no capital gains distributions. So the dark line represents the pre-liquidation, so you haven't sold anything. And then the turquoise is after you sell your shares. So you can see the value is growing over time, and there's a significant gap between the ETF portfolios and the mutual fund portfolios due to the fact that you're not paying that tax along the way. You're keeping the money invested inside the strategy, and it's compounding over time at the rate of the return of the portfolio. And this gap gets bigger as the time goes on, and it can be, it can be a significant difference. So what are the actual numbers? The difference between the ETF and the mutual fund over 20 years, even after you sell your shares, was 300 grand, a little over 300 grand. So, pretty significant savings in a taxable account. It's less so in shorter periods because, a big part of the difference is from the compounding of that savings.
Yeah. I was going to say, it's amazing that difference when you just look at the annualized return. Let's just look at the 20 years, and the annualized return in the mutual fund is 7.46, and the ETF is 7.85. It doesn't sound like a huge difference, but when you put the dollar figures to it, that's where you can really see the difference.
Yeah.
And one of the other tax items that we didn't talk about in this too, though, is if, let's just say, you've been a long-term investor, you've been invested already 20 years, and 20 years ago the mutual funds were the place to be, right? So one of the other things to take into, because one would argue, well, if I'm in a mutual fund now, why don't I just get out of a mutual fund and go straight into an ETF, right? So remember, one of the items that you would look at too is, what would it cost you to get out of that mutual fund to go into the ETF, and kind of what the break-even point would be on, hey, I'd have to be in this ETF, this long for it to make sense to then realize all the taxation of it. And so that may be why, you're transitioning over a period of time versus doing it all at once to help limit some of those taxation.
Yeah, it's a huge point. I mean, it's not something that you just do a quick change. You do need to consider the tax situation, but I think it's an important subject because in this industry there is innovation. I think this ETF structure has brought some significant efficiencies, and rules have changed so that you can access, an academic-based investment approach that used to only be available in mutual funds. So until recently, now you can do this daily management using the academic research in this ETF structure. So it is, it's really a great thing for the industry.
Yeah. So before we get into the disclosures, I'm sure that we have to show, did anyone have any additional questions that they could think of that haven't been asked? And then Jeff, you want to just go through the disclosures that I'm sure you have to show while we're
it's good you remember that, because I definitely probably would have forgot to do that.
So somebody has what looks like a joke, and I'll give everyone one guess who it's coming from, and that would be Dale. So he says, do fish get thirsty? Okay, let me hear the punchline to this. Remember, this is being archived forever, so hopefully that it's a good one. Come on, Dale, you gonna tell us the punchline or what? Suspense is killing me. All right, Dale, you got 5 seconds. I'm gonna have to Google, do fish get thirsty? The punchline's no, really? That was uneventful.
I was expecting some complex answer.
So was I.
Biology of fish
So,
hydration.
yeah, so was I. So, well, thank you everybody for joining us. If this spurred any questions, please don't hesitate to reach out. And Jeff, really appreciate you spending the time and going through this with us and our clients. And we will send this out once the recording's approved and everything out to everyone. So if there was a couple areas, maybe that you wanted to look at, more in depth or re-listen to, feel free. Eventually, these will be up on our website and stuff, so you can have access to them whenever you want. So thanks again, Jeff. Really appreciate your time and thank you for your expertise.
Yeah, thanks for having me on. Hopefully everyone stayed awake and learned something.
Yes, they did. Appreciate it, sir. We'll talk with you soon. All right. Bye.
Okay, bye.